Good evening and welcome to Radboud Reflects. My name is Chide Tempels and I will be your host this evening. And we're live from Lux and we're going to talk about negative interest rates and whether that's a positive thing or not. For negative interest rates are kind of an economic anomaly in a way. For it used to be the case that you would go to the bank and you would put money on your bank account and then you would receive interest. And when you would want to buy a house and you take a loan, you would have to pay interest. But that suddenly seems to be changing. For earlier this year, the Dutch bank announced that it might likely be that the interest rates will become negative. And that on savings accounts, the interest will become lower than zero. So how does this work? Why do negative interest rates occur? Or why do these policies arise? Can we stimulate our economy? Can we boost it with these negative interest rates? And what does it do with the way we perceive the economy? Well, a lot of questions. And about these questions we're going to talk this evening. I will be doing this together with Radboud economists Stefan Zeisberger and Ivan Boldyrev. So how does this evening look like? Well, we'll start with two short lectures. We'll first start out with a lecture by Stefan Zeisberger. He's a professor of financial economy at Radboud University and the University of Zurich. He would have been here physically, but sadly he couldn't be, but he did record his lecture, so we'll be showing that first. In this lecture, he will briefly elaborate on what negative interest rate is and how it affects our economy. Afterwards, there will be a short lecture by Ivan Boldyrev, who will provide a more philosophical analysis of the concept of interest, and he will also reflect on what it means for negative interest. After that, there will be a Q&A session in which I will briefly interview Ivan, and you can also send in questions via Mentimeter then, but I'll return to that when the moment arises. So, without further ado, I will give the floor to Stefan Zeisberger, and we can watch his video.
So welcome everybody to my talk today on negative interest rates and the causes and consequences thereof. I hope you're all doing well and healthy in these rather crazy times. All right, I want to divide my talk into four parts. First of all, I want to clarify what negative interest rates actually are, and I want to define that so that we know what we are talking about. In the second part, I want to explain to you and outline why we have negative interest rates at this moment. Third, might be quite interesting for you, what are the consequences of negative interest rates? So what does it mean? What are the benefits? What are the costs for households, for you, for the government, and for companies? And last but not least, I want to explore a little bit the current COVID-19 crisis, how it affects interest rates and the economy, and I want to give you an outlook of what you can expect interest rates to be in the future. All right, let's start with the first part. What are negative interest rates? First of all, as an economist, you will say that interest rates are the price for borrowing money. So anything in the economy has a price. Milk has a price, cheese, a car, a house, all these have a certain price. Prices can go up and down. And the interest rate is the price for borrowing money. And also this price can simply go up or can go down. So if you want to borrow money, you will have to pay a certain price for that, and that is basically the interest rate. And someone who lends you money will receive that price, so that will receive the interest rate. What is currently happening is that this price for borrowing money has become negative. That means that you pay money when you lend it to others. You have to pay someone who borrows money from you. Well, importantly, we have to distinguish different interest rates and define what we're talking about here. Real interest rates have been negative already for some time. What do I mean by real interest rate? Real interest rate means the nominal interest rate minus an inflation rate. Let me make an example. If you go to whatever bank you are at and you have a deposit, and in your savings account you receive, for example, 1%, that is what you're offered, but the inflation rate is currently 2%, then you are losing money in real terms because the inflation rate is higher than what you receive on your savings account. This has already happened in the past. That's nothing new. The new thing now is that we have negative nominal interest rates. So even on a nominal basis, you receive a negative interest rate. So the price for borrowing money is negative. We do not have this everywhere, but in some occasions. Let us look where. It's important to note that there's many different interest rates out there in the world. So, for example, we have central bank interest rates. These are the rates that a central bank, that is the bank of the bank, basically sets for financial institutions. Then we have government bond interest rates or government bond yields. That is how much money or what kind of interest rate your government will have to pay for its debt. And then we have other interest rates, for example, those on savings accounts, consumer credits, and mortgages. Not all of these interest rates are negative. Negative are the first two, that is central bank interest rates. Many central banks all the world, but not all of them, have negative interest rates. And so are some governments currently paying negative interest rates on their debt. But this is exclusive to some countries. Where we have no negative interest rates yet and unlikely to have this in the future are the further savings accounts, consumer credits, and mortgages. So if you dream of a mortgage with the negative interest rates, that's unlikely to going to happen in the near future. It's also important to know that we have different interest rates for savings and for borrowing, as you can see here. All right, having defined the different interest rates, let's explore why the interest rates on some of them are currently negative. In order to understand that, we need to look at the central bank and its goals and monetary policy. So the central bank that is responsible for us here in the euro area is the European Central Bank. And the central bank, the ECB, has certain goals. Most importantly, the ECB has an inflation target, so it tries to keep the inflation rate at 2% per year. But there are also some more or less unofficial goals. There is a low unemployment rate and a stable currency exchange rate. So, for example, the euro against the US dollar should more or less stay stable and do not fluctuate too much. The ECB has many instruments to achieve these goals, and mainly the inflation target. But the most important goal, or the most important instrument, is basically setting the interest rate. Now, to understand why interest rates are negative, we have to look at the economy and how the economy is doing. Typically, if the economy is doing well, that means that unemployment goes down and the inflation rate usually goes up. So consumer prices go up, wages go up. In these times, the central bank and the ECB in particular tries to cool down the economy by increasing interest rates. On the contrary, if there is a recession, the ECB tries to cut down on the interest rates, to lower the interest rates in order to stimulate the economy. So how does it work? If you have lower interest rate, it's basically cheaper to borrow money, and therefore it's cheaper for companies to borrow money, it's cheaper for households to borrow money, for mortgages, to consumer spending, etc., etc. And this will then hopefully boost the economy. So you can clearly see that in what state the economy is currently in heavily determines the interest rate of the central bank. Let's have a look into the past to see this. Here you see the historical central bank rates of different regions and countries. And I indicated two crises for you. That's the dot-com crisis in 2000 and the financial crisis in 2008. And you can clearly see that at these crises, basically, the central banks all over the world, they heavily reduce the interest rates to stabilize and stimulate the economy. And if it goes up again with the economy, the interest rates are usually raised. And these central bank interest rates they are the main driver for all the other interest rates we have in the economy. For example, for the governments, on savings accounts, on mortgages, etc. So that's absolutely important to understand that. So the economy drives basically the interest rates. And here you can see basically the current interest rates of different European banks and the Bank of Japan. And you can see that as of 2015, most of these central banks have negative interest rates, at least in Europe. The US Federal Reserve does not have negative interest rates yet, but might follow soon. Let's see. Let's look at other interest rates, for example, what the government has to pay for its debt. Here I gave you an overview over the last approximately 2 decades about government interest rates. And you can clearly see that they have gone down dramatically over the last 2 decades. And for some countries, they are actually now negative. So this would be foremost Germany, Switzerland, followed by Netherlands and France. So for these countries, governments receive money for having debt on nominal terms, not even taking into account inflation. And that is a little bit the crazy thing that is going on at the moment with the negative interest rates. So you borrow money and you receive money for that. You receive an interest rate for that. So let's understand why we have the negative interest rates. As I said, the central bank tries to stimulate the economy and keep the inflation at 2%. If we look at the historical inflation rate, we see that inflation has not been a problem over the last 20, 25 years. So we have hardly had any times where the inflation rate was too high. So there was no incentive for the central bank to increase heavily the interest rates. Just the opposite was sometimes true, that the inflation rate, that is how much consumer prices are rising, this inflation rate has been rather too low than too high, putting some pressure for the central banks to decrease, lower interest rates. Let's look at some other indicators. So having said that inflation rate isn't the problem, let's look at other factors. First of all, the unemployment rate. Here I depicted the unemployment rate basically from just before the financial crisis in 2008 to today in selected European countries. You can clearly see that Netherlands and Germany, as examples, have been able to get to pre-crisis levels or even below that. So you have unemployment rates that are relatively low compared to a pre-crisis level, same level or even lower. At the same time, you see that some other countries have massive unemployment problems still. I mean, unemployment has gone down since 2013, 2014, where we have the highs. If you look at France, Italy, not to speak of Spain and Greece. But as a matter of fact, these the unemployment rates are still way above the pre-crisis levels. So we still have a huge unemployment problem in these countries. So from that perspective, the ECB hardly has any chance to increase interest rates, because if you increase the interest rates, you will slow down the economy, and that will negatively affect the unemployment rate. Let's look at another indicator, public debt. So that is the government debt in selected countries. They are the same countries as on the slide before. Let's look again at the pre-crisis levels and the current levels. So it's pretty much the same time span here. And here you have the public debt in percentage of GDP. That is how you usually measure public debt. Again, Germany, Netherlands are doing pretty well, be almost at the same level as pre-crisis in terms of public debt. Well, if you then look at Spain and France, for example, they are way above the pre-crisis levels. If you look at Spain, if you look at Italy and Greece, it's even much worse. So on all these countries, maybe with the exception of Spain to some extent, they haven't even started to reduce their debt levels. So whereas Germany and Netherlands for quite some years already are able to reduce public debt, all the other countries, maybe with the exception of Spain in this chart here, have not even been able to reduce their debt levels. And now think about it. If interest rates are high, then these countries have to pay a very high price for their debt. This will simply be impossible for these countries. So that creates another huge pressure for the European Central Bank to keep the interest rates low and to have it even at a negative level. So the ECB does so because there's no risk for inflation, as we pointed out, but there's huge risks of unemployment, and there's still a massive, massive debt problem. All right, let's move to the third part of the presentation. What are the consequences of the currently negative interest rates? Here I want to point out some benefits and costs of these negative interest rates. So let's start with the benefits. A main benefit of having a negative interest rate or a very low interest rate is that you basically avoid deflation risk. So as much as you want to avoid high inflation, you also want to avoid deflation, that is, that consumer prices on average go down from year to year, because that is relatively risky for the economy. Because people do not like to spend anything, to consume anything, because they believe prices will go down in the future. A further benefit of having these super low interest rates and negative interest rates is that you stimulate the economy. That will have positive effects on the unemployment, export industry, etc., etc. So the main reason why we have these super low interest rates is to stimulate the economy. It also is pretty much the only way that countries like Greece, Italy, Spain, and France will be able to pay off debt. If they have high interest rates, they will simply not be able to pay it back. And this will be a major threat for the European area and for the euro as a single currency. Also, if you think about yourself, it will basically decrease the cost that you have with owning real estate. So mortgage rates are more or less still at historically low levels. That means that if you purchase a house, you will have to only pay a little in interest. That is, of course, quite beneficial if you want to purchase real estate. Well, these benefits come also at some costs. What are these costs? The first is that basically we have been seeing over the last 12 years approximately a massive increase in real estate prices and a massive increase in asset market prices. So, for example, in the United States, the major stock index went up by 300% in just 11-12 years. The AEX, as the major stock market index in the Nederlands, went up by 200% in the same time period. So these are massive increases over a short period of time. I will show you a slide in a second about the real estate prices in the Nederlands. Second, it creates a pension fund problem. So we might be in a sort of like a bubble scenario regarding the first bullet point. The pension fund problem is a much more long-term problem, and something that the newspapers and the media doesn't catch at the moment at the level it should probably have attention. There will be massive pension problems. The reason being that much of the pension funds are invested in government bonds, and if these government bonds now yield negative returns, as we just pointed out, well, then your pension portfolio also yields negative returns. The solution to the problem would be to invest more in stocks, but that's currently not really legally allowed for these pension funds because it is believed that government bonds are safer. I think that's a misbelief which we might want to correct in the near future. The third point is that having negative interest rates creates massive problems for banks. Banks' business is basically to lend and borrow money, and out of that difference in saving and borrowing interest rates make some profit. At the moment, banks have to pay money for their deposits at the central bank because the interest rates of the central banks are negative. But the banks, at the same time, are not able to give these negative interest rates to their clients. So it will not be possible to simply say to any average consumer bank client that they're going to have negative interest rates from now on, because what consumers and bank clients will then simply do is to take out the money in cash. So what banks are doing is basically increasing the fees here and there, so making your current accounts more expensive or increasing the fees at other points in the business model. So, but basically it causes a major threat for banks. And the further this goes on with the negative interest rates, the more dangerous this will become. And last, there's basically central banks are going out of ammunition, so to say, if there's a next financial crisis. So now we are likely entering a new financial economic crisis, and the central banks are simply running out of possibilities to stimulate the economy even further. Here, the promised slide on real estate prices and the potential bubble danger here. So if you look at real estate prices in the Netherlands, they have gone up dramatically. One reason for that is that you have such low and now even negative interest rates. If you can for almost free borrow money to put into a mortgage, then of course that increases the incentive to buy real estate. And the more people want to buy real estate, the higher will this increase the prices. Let me move to my last point of the presentation, the COVID-19 crisis, and let me try to make an outlook of what you can expect in the near future. So the COVID-19 crisis basically causes large economic uncertainty. So we do not know what's going to happen in the near future. This is basically unseen in the recent history economically. And that basically pushes interest rates a little bit up. So we have seen interest rates for governments going up. We have seen mortgage rates a little bit going up by 20 basis points, more or less. So there's quite some pressure for interest rates to go up. Now let's come to the second, third, and fourth point. So at the same time, we are just in front of a considerable, massive recession, where we don't know how long this is going to take. It can be 1 year, 2 years, maybe 5 years. We just don't know. And as I said in the beginning of the presentation, in a recession, you try to stimulate the economy by lowering interest rates. So this recession that will come will put some pressure that the interest rates are going down further. The same is true with public debt. If you look at the spending programs all over Europe, all over the world now because of COVID-19, again, these numbers are almost crazy. Just to help people going through the crisis, look at the tourism industry, look at HoReCa. There's massive problems that need to be solved, and the government is doing its job. But this will increase massively the public debt. And how do you get out of this debt crisis? It's only possible if you have low interest rates or even negative interest rates. And there are some studies showing that pandemics have a decreasing trend on long-run interest rates. So what can we expect? Here's my outlook for the future and also my last slide here. I foresee the future as follows. Interest rates are likely to stay low and even negative in the future. Given the economic crisis that's going to happen, given the high unemployment rates, given the high debt levels in many European countries and the increasing debt levels, it's very unlikely for the interest rates to be increased. This will be good for the governments because they have finally a chance to get through this debt crisis with very relatively high debt levels. But for you, it will also imply that say goodbye to any interest rates on savings accounts. There will be hardly any possibilities for you to save money safely with any interest. At the same time, mortgages will probably remain relatively cheap. And this comes probably at also increasing real estate prices. So interestingly enough, the COVID-19 crisis, we have not seen decreasing real estate prices, and it can well be that the real estate prices will stay high. As I pointed out, if we still have these negative interest rates and no shift in how pension funds can invest, they will have a massive problem that will become bigger and bigger. So the policymakers are asked here. Generally, in such an environment, it's very difficult for savers because you will not get any money for money that you are floating around. And last point, I want to mention that there's new tax regulation about the wealth tax in the Netherlands coming up, where you distinguish between how you invest your money. So you will have to pay less taxes for your savings accounts and more taxes for money invested in real estate and in stocks. While I understand where this regulation is coming from, it also is a little bit dangerous because it gives a further incentive to park your money at zero interest rates and basically have a huge punishment for that because there will be some inflation and your money will become less and less worth. It just simply creates a disincentive to invest your money in stocks. And so the outlook will be basically interest rates will stay low in the future, and you will have to deal with that and with the consequences that I just outlined in this presentation. Thank you very much. I hope this was clear, and I wish you a great event.
So now that we have an overview of the current financial situation and how negative interest rates fit into this, we thought it would be good to dive a bit deeper into the notion of interest itself, the historical background, and the ideas that drive it. And we'll be doing that with economic philosopher Ivan Boldyrev. Ivan Boldyrev is assistant professor of economic theory and policy at Radboud University, and in his research he focuses on the history, sociology, and philosophy of economics. Ivan, the floor is yours.
Yeah, thank you very much, and good evening, everyone. What I would like to show you today, or to share with you today, is some sort of historical context for interest rates, what interest rates are, and where they come from, and where we're heading. So I would start with the very old notion, and this is the notion of usury, which is the very situation of taking money for lending money. And the word itself suggests that we somehow use the one who is borrowing money from us, and that we use this situation to earn money for ourselves as creditors, as lenders. So what we see in the sources, in the historical sources from the very beginning, is a critique of usury, condemnation of usury, ethical arguments against usury. And it starts from the father of economics, or economic ideas, let's say, one of the first economists, we would argue, Aristotle, who was saying that basically you may not earn money by lending money, because money is not, it's just a means for exchange. It's not a good in itself. It's not a commodity. You can earn money only in return for some kind of a real good. A medieval thinker, Thomas Aquinas, who was very much a follower of Aristotle on that, added to that by lending money you actually try to sell time, which is impossible. we have throughout medieval Europe, Islamic world, Islamic banks today, we still see that interest rates are not allowed there, are somehow considered to be, well, a sin. And this nice picture of Rembrandt of Christ expelling the money changers from the temple, also on one interpretation would mean that those money changers also lend money for interest. So this is also a usury. And Jesus Christ, expelling them from the temple, somehow also condemned this practice or this type of financial operations. But what is important to understand here? We are talking mostly about consumption loans, about very poor people who didn't have money just to eat or to maintain themselves and needed for the new vintage or for the new agricultural year. They needed something to survive. Now, that was what usury was about, and they could. It was not even. It could be not even monetary. It could be just bread or food, which you would then return with interest. So with this delta in exchange for the ability to get it now. But the critique also meant that the practices of interest rates, of lending money for interest, were widespread. And the economists over those years came up with lots of arguments in favor of positive interest rates. It was considered as a payment for risk. I lend you money, but I don't know whether you give it back to me. Then, of course, I need some more as some kind of possible return for my risk. I could have invested money differently. I do not do this. I give it to you. Of course, you have to pay more back. I look optimistically into the future, and this optimistic look, in particular underestimating future needs or overestimating future wealth, implies that money today is gives me more, let's say, utility or wealth than money, the same money tomorrow, which means that I need it now and I'm able to pay more for this money to get it now. Another important argument in favor of the interest rate was that the very production process or productive investment takes some time. So I get money, I invest it, but I have to wait until I get a return on my investment, until the production process yields this surplus. Now, once I have this surplus, I can pay money back out of this surplus. And I expect this surplus to be actually much higher than the interest rate, so that I get my profit as well as a capitalist, as someone investing, someone borrowing and investing money in the real economy. So summing up, interest rate and positive interest rate is a feature of a dynamic, developing, expanding industrial capitalist economy. And we expect that the investment there always gives us, high or preferably higher return in future. And this is linked quite naturally to the positive interest rate, to the financial sector which serves our needs as industrial capitalists. I like very much one episode from Lewis Carroll's Sylvie and Bruno fairy tale, which features a crazy professor. And there is a nice scene there when the professor sits there and Sylvie Bruno's the major heroes coming to his place, and someone knocks at the door, and the voice says, "It's a tailor with a little bill." "Well, I can soon settle his business," the professor said to the children, "if you'll just wait a minute. How much is it this year, my man?" So the tailor wants money from the professor. Professor obviously is in debt. "Well, it's been doubling for so many years, you see," the tailor replied a little gruffly. "And I think I'd like the money now. It's £2,000. "Oh, that's nothing," the professor carelessly remarked, feeling in his pocket as if he always carried, or at least that amount, with him. "But wouldn't you like to wait just another year and make it 4,000? Just think how rich you'd be. Why, you might be a king if you liked." And then the tailor starts hesitating and, well, eventually agrees to wait. "And of course you will," said the professor. "There's good sense in you. Good day to you, my man." And the tailor goes away. And then the kids ask the professor, "Will you ever have to pay him that £4,000? And of course the professor answers, "Never. Never. Because he will always come, and the professor will always promise that the sum will be doubled. It will never stop. That's an unending, expanding, growing debt." And this promise of return is the very foundation of capitalism. And basically, John Maynard Keynes, who actually told this story in one of his essays, says that, well, this is kind of a substitute for immortality in the capitalist economy. That's a type of immortality capitalists can get, because they always know that this will be growing, that money tomorrow is better, is more important than money today. Now, summing up, when we talk about the society of yesterday, the society of positive interest rates, it is the society of growth and optimism. And that is why it charges price for investing and gives a premium to savers, gives a premium to those who bring money to the bank and expect a return on that. Keynes was suggesting to lower this price exactly for the reason that it needs to boost the economy, to make investment cheaper and to increase aggregate demand. But interest rates are not something which is naturally given to us, although it might seem so. They are something we create, and we are, let's say, we're not controlling it fully, but that's kind of emerges out of human interactions. And this can change, of course. And this, in the society today, it's been changing a lot. To the point that we somehow even come to this pre-positive interest rate times, when there was no interest rates, or at least in the ideal world, we would say we shouldn't have that. And this creates, I was thinking about what kind of societal challenges this could create, and I'm coming up with 3 of them, which are of a different nature, but I believe equally important, and perhaps we could think about further problems. One is, of course, the efficiency of monetary policy, which was always built on this idea that you can actually control interest rates and eventually, make them higher to evade, to escape inflation, and make them lower to boost, to kind of give more caffeine to the economy. Now, probably it means that the standard monetary policy instruments are becoming less relevant, and in the worst case scenario, you need fiscal policy. You need kind of state interventions in terms of state spending to regulate the economy and to help create additional aggregate demand. Then, of course, in the previous lecture by Stefan, there was this idea that people don't like to be punished for keeping money, for saving money on the bank accounts. So on the one hand, it's obvious that we have to rethink the idea that, well, cash might turn more profitable or more attractive for many money holders. On the one hand, on the other hand, there are obvious costs of holding cash today, and in the increasingly cashless economy, it's kind of strange how we're going to deal with this huge amounts of cash, how to pay with this money which we're holding not on bank accounts but somehow in a different form. All issues of privacy and security, of course, pop up here. And finally, the very idea of economic rationality or frugality and the things we may expect from our economy in the coming decade will change or should be somehow reconsidered in view of the negative interest rates. Thank you for your attention. I think I'm done. Yeah.
All right. So thank you, Ivan. So it's now time for Q&A. And normally I would just have a couple of questions ready. But this time the audience can also participate. And they can do this, or you can do this, by going to Mentimeter. And you go to www.menti.com, where you can gain access with a code that is visible on our YouTube channel. And I will then do my best to put forth your questions as well. But naturally, Ivan, I also have some questions I would like to ask you. So some people, so you gave us a historical overview of the concept of interest, and it seemed to have increased, and now it's gradually decreasing the interest rate. But I was wondering, some people refer to this negative interest rate as something special, something counterintuitive, and it's something that we've never seen before. Mm-hmm. So, as an economic historian, are there indeed no historic precedents?
I think in the current form, there were really no historic precedents. And the data shows that the tendency of decreasing interest rates, long-term decreasing interest rates, is really not the phenomenon which started with the financial crisis 2008. But started happening much earlier. And we are talking also about the economic system with central banks defining their interest rates, with other banks adjusting to this interest rate, which is really a kind of post-war phenomenon, and with independent central banks, so central banks independent from political power, it's really 1970s, 1980s. So that's kind of time span we're talking about.
Yeah.
And in this time span, or generally in the 20th century time span, this is really kind of very new and unusual thing.
And is it then also possible that this can only occur due to some kind of coordinated endeavor, or?
Yes. I mean, it's again, if it is, it did not happen. It didn't happen unexpectedly. It was happening over years. It was lower, 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 and of course, the exact level of interest rate is subject to some kind of very concerted, heated debate within the European Central Bank, within monetary authorities. Central banks think about what they do in different countries and kind of coordinate that as well. But it also implies or somehow demonstrates that interest rates in the economy generally are low.
Yeah.
Not because central banks tells them to be low, although it does play a role as well. But there is some kind of interaction here, and economy somehow accepts that.
Yeah.
Banks accept that.
This tendency for the interest rate
to
drop.
decrease. Yeah.
Right.
Yeah.
So in your lecture, you briefly referred to interest being somehow a natural part of our economic system. If that's the case, does that then also hold for negative interest, or is this some kind of new anomaly we somehow constructed?
Natural in the sense that it's kind of inherent for our economic system. Economic system is not natural, it's man-made, right? It's human kind of thing. So we are changing it. But of course it creates some it gets some durability. So there are things which are a product of coordination of many economic agents, and they cannot be changed overnight. So and that's kind of new reality we have to live in. Not only the reality of low interest rates, but also the reality of low growth rates, of low inflation, which accompanies, in a sense, low growth, and is also not a very nice thing, although we want the inflation to be low, but not too low.
No.
So there is this,
somehow, right? Yeah. There's a question, and it kind of touches upon this. It refers to the causes of this whole policy. So the question is: in our aging society, more older people are they not one of the causes of these negative interest rates? Since we, the Netherlands, and for instance Japan, you see such a tendency, and people have a tendency to maybe hoard money.
Yeah.
How do you view this?
Yeah, the older people really spend less, and this might be a problem for aggregate demand. I wouldn't call it really a problem, but that's kind of a let's say part of the reality which we cannot change really. So yes, and this is the part of this, what some economists call secular stagnation. Secular meaning very long-term stagnation.
But why is it called secular then?
Because it's about secular meaning seculum, like century. Century old. Right. Secular stagnation. Which also comes with the population, with a certain population dynamics in the developed world, but also not only in the developed countries, but everywhere. What happens and what to do? That's also a good kind of. What can we do with that? And one obvious answer, which economists are now contemplating and actually implementing is, of course, gradual increase of the pension age, so that people work more. By working, they earn more and they spend more, and the economy somehow gets more investment, let's say.
Gives more room to flourish. At the same time, though, I'm wondering, I myself as a consumer, I see the interest rate on my bank is declining, and I think at my bank I even have to pay already for to have an account there. It seems in a way, I mean, I understand that it is important for in this economic system for the economy to grow. However, shouldn't consumers be free to determine what they want to do with their money? And in a way, you're now being punished for keeping your money on your bank account.
Yeah, true. Well, once you are a consumer, you are part of this economic system, and then you have to navigate in it in one way or another. And it really turns out that it does have problems. It does create problems for savers, for those who save their money and then get not punished, but have to pay fees for this kind of activity. And this implies, again, as I said, that many people will have to rethink their strategies, their saving strategies, what they're going to do with their money not to lose, at least relatively. And there is some sort of privacy or, let's say, security issue here.
In what way?
Your money, once your money is all e-money, right? It's kind of, we could argue, much more transparent.
Yeah.
For tax authorities, for everyone, all your transactions are stored somewhere, and it gives you much less privacy than the case of cash transfers. And this is an issue, and this has to be somehow, there is a tension to be resolved here in one way or another, and negative interest rates somehow add to this picture, but that's not, even in the world with positive interest rates, that's going to be an issue too.
Right. Yeah, no, that then still stays the same. I think there's another question I would like to look at. Yeah, I'm not sure. I'm going to pose it to you anyway, but if you say, well, it's not really my topic, then we'll switch. It refers to something that Stefan has said.
Yeah.
And he said that lower the cost of owning real estate. However, this makes a real estate problem skyrocket, and we still see this. So the market is flooded by money. Do you think could this lead to a new bubble? And would that also create a problem?
I would be very cautious in trying to predict anything on this market, and it's really not something I could do. But I completely agree that there is a danger here, because. You have you always have, as we face today, some kind of a radical uncertainty when it may happen that people become that there are defaults on those markets, and then the events which could follow could be really unpredictable, also in terms of asset prices.
Yeah, no, I understand. At the same time, and I think we talked about this already a little bit, but to me it still seems like negative interest seems counterintuitive in a way, and I think this holds for many people.
Yeah.
especially when you want to open a bank account and you see, hey, then the interest rate is negative. This is going to cost me. Mm-hmm. And then you see the government is able to take out loans, and then they have to, in the end, they have to pay less back. So, how do you wrap your head around this? And I understand that in your research you're also looking at human economic behavior. So, can this current practice of negative interest rates also lead to some kind of friction between what economic theorists would expect how humans would behave and what these consumers are actually doing or are going to do? So, for instance, I can still save, or I can indeed turn to cash, although now that would be a tricky time probably, but...
Well, still, interest rates, economy-wide interest rates, are a macroeconomic phenomenon. It's a phenomenon which somehow exists for the whole economy, and that's why the central bank policy is so important here. Will it change our standard notions of economic rationality? I doubt that, although, as I said, there could be different ideas about what frugal or what kind of rational behavior on financial markets or with doing something with one's assets means. But that's another story. The real problem here is that the economy somehow stops being built on the expectation of future return, of future higher or ever higher return, of a constant, unstoppable growth. It comes to this kind of, well, stable but not growing issue where this future is not something you would expect as which brings you more fruits. Is it good or bad? I don't know. But as I said, the previous logic of economic activity was tightly connected to the idea of productive investment and the financial sector serving this productive investment and growing together with the industrial sector. Yeah,
I think there's a question that ties into this, posted by one of the viewers, because one of the other logic or one of the other key concepts in our economy is debt. And this person asks, so is the idea of debt, and that could be increasing with the government taking out new loans, not something that is negative or harmful to society? Does it not make differences between the poor and the rich greater? These are a lot of questions. So let's start with that one, and then I'll go to the last one later.
Debt is fundamental. Debt is fundamental. It remains fundamental. It is built on this temporality, on these different registers of time of today and time of tomorrow, and how they differ, and how you switch between those times by giving money now instead of earning them tomorrow, or buying a house or getting a house now and then paying your mortgage tomorrow. And yes, I don't know. I don't think that the debt as such as a phenomenon will disappear. It will not. But the terms on which debts will emerge might well change.
And how do you see this? Or how do you feel this? Because maybe
the easiest thing. I mean, the easiest thing, of course, this kind of when you don't pay interest at all. Yeah. When you don't pay interest at all, when you just borrow money and then bring it back because the economic conditions or the economic environment is like this, you just the interest rate is just zero. Another thing to think about is the so-called Islamic banking, where in Islamic countries, when interest rate is prohibited, there is this forms. I'm not an expert in this, but from what I've heard, the idea is that interest rate is zero, but the banks or lenders somehow participate in the investment projects.
Okay.
So they are not separated from the real sector which they credit. They are part of this, and this makes this is, of course, this is not so widespread in the economy today, where financial sector is really pretty much autonomous from the real sector. But still, this is the idea. You lend money, and then you control it, or you're much more involved in the whole process of investing, making this money work. And again, it boils down to the idea that you're not supposed to get much out of this nowadays. Out of the productive investment, out of real sector economy, not in the way it was possible before.
Yeah. Another question, again on a key concept of the economy, I think. And the question is, so this is being done also to stimulate growth. And the person asking this question says, well, can the economy only grow if consumption keeps growing? Or are there other ways maybe to boost the economy?
The Keynesian wisdom will tell you that it's impossible for economy to grow if only consumption grows. It's impossible for consumption to grow without growing of demand. You cannot consume without spending.
Yeah.
You have to spend, and by spending, you give the consumption to other agents, right? So perhaps it was implied in this question that our consumption standard, the ways we consume are somehow increasing, whereas there is no real foundation for that. If the industrial production is lagging behind, so it's a very difficult story. But some answers I'm aware of are, of course, that we have non-material production or new technologies, which also kind of are now the driver of economic growth. And there is a growing inequality, which is also a reality of the last decades in the developed world. So we pay for this growth, or for this type of development, also by increasing inequality.
And well, that ties in with another question. So indeed, so if inequality is spreading, the gap between the rich and maybe the powerful and the people who have less influence and goods as well might be growing. So these negative interest rates, I mean, qui bono, who benefits from this? Is it possible for society as a whole to benefit for it, or is there again a smaller?
As always, there are winners and losers. There is this obvious idea that also was mentioned in Stefan's lecture, that the savers, those who have huge amounts of money, who are risk averse, who don't want to invest money in stock, who keep money on their accounts, are losing money. obviously,
Yeah.
due to these negative interest rates. The richer you are, the more you lose, obviously, right? So, of course, it depends on how you, what your attitude to money is. But in monetary terms, this is, of course, true, that those who, the dispossessed, could, in the short term, could profit from that, of course, because they may get cheaper credit.
Yeah, yeah. I want to make a step towards policy, as Stefan also referred to this in his lecture. And we saw these negative interest rates already coming up before the corona crisis.
Yeah.
And so the ECB already started doing this in order to boost the economy. Now, we might be facing another recession. Are there any tools left to boost the economy, or are we now out of options in a way?
Yeah, so I really hope that it won't come to this, that we somehow run out of instruments, but generally, if you have the problems with demand in the economy, with aggregate demand in the economy, you may lower interest rate to stimulate investment, but if it is impossible anymore, then fiscal policy comes in, government spending, direct help, any kinds of directly stimulating or giving money to specific to private businesses, to those who lose, definitely lose money in a short term, on good terms, then that might be a solution to survive, to maintain operations.
Yeah. Okay. I'm going to turn to another question from someone from the audience. Yeah. Well, I think this person really reflects this counterintuitive notion of negative interest rates. He says, well, she says, negative interest rates are irrational, seems to me, to pay money to store your money. It sounds counterfactual. Is it then better to put money into objects and goods rather than to save?
Yeah, as again, I could only reiterate what Stefan said. Okay, you may go and invest money in whatever you wish, buy commodities or go on the stock market.
Yeah.
So buy parts of the businesses, but what will banks do? Which earn money by on this change between deposits and credits.
Yeah.
If you won't bring them money to have the resources to credit. So that's, of course, the question.
At the same time, it's a tricky thing, and I can see where the question is coming from, because another person here remarks, well, I mean, we see intensified saving patterns. So people are keeping the money in their pockets. But could that not also be a reaction to growing economic insecurities that people face, especially maybe now, job loss, the housing market?
Yeah.
So at one hand, you can say, okay, we're going to lower the interest rates in order for people to spend. But if you're facing job loss or you cannot find a house, then, well, it's easier said than done, especially now in the housing market, that you have to have a certain amount of money in order to even be able to buy a house.
Yeah. Yeah. So there are two components here. Again, one short term, and this is the current crisis, the current months, which is, I absolutely agree, that's high uncertainty. Why would you spend money? No. That's one short-term element. But the longer-term element, again, is also important. And one of the explanations, which was given also in the previous question, was the aging population, which spends less and is not so active in this kind of life of economy dynamic life of aggregate demand.
Well, okay. We're already out of time. This is going really, really fast. So, Ivan, I really want to thank you for being here tonight. I also want to thank Stefan for participating in this program, albeit digitally and on a distance. For people at home, next week on Tuesday, the 30th of June, we'll have another live program on vital professions. This program will be in Dutch. The stream will be online a bit longer, for another 30 minutes, so feel free to continue and discuss about all the things we've talked about this evening. That's all for now. I thank you for watching and I thank you for participating. Be sure to subscribe to our YouTube channel and sign up for a newsletter. And we hope to see you again next time at Radboud Reflects. Have a very nice evening.